Okay, before we start, let me drop the file in here. Welcome to the 7th class. Wow. Oh my God. Like 6 classes for laws and regulations. We get one more class for that, law and regulation too. Okay. So just so you know, we will not have class tomorrow, okay, Friday, because I booked a reservation for a restaurant like 3 weeks ago. So so that's why tomorrow I'm gonna go to eat out on this new open restaurant. It's called Steak 48. Okay, recently opened in San Diego. So I just want to go out and enjoy my night. So we're not gonna have a class tomorrow, but we're gonna continue on next week. Okay. All right, let's start. Welcome to the 7th class. Woohoo! We make it 7 times. Okay. We got one more class, talking about laws and regulations, and then after that, we're gonna go in deep on the fundamental, the practicing, the activity between realtor and loan officers, and all the activity in between, during the escrow time. Okay, they're gonna be get more interesting. Okay. As folks say, that restaurant only 3-star, Michelin 3-star. That's okay. Just want to try it out. Just a hype. That's all. Okay, 7th class. All right, nothing general here. All right, so we're gonna keep going down this list. Majority of the today class is about flood, Homeowner Protection Act, and a couple of flood. Okay. Right. So first thing first, National Flood Insurance Act, NFIP, established in 1968, which is a reg age. Okay. The National Flood Insurance Act is a U.S. federal law that was enacted in 1968 to address the need for flood insurance coverage for property located near the flood-prone area. Right. It established the National Flood Insurance Program. Okay, this law, NFIP, which is administered by the FEMA. We probably have heard about FEMA a lot of time, right? When we see a lot of flood, on the East Coast, like Florida. I'm not sure if there's any flood in Texas. Right. So FEMA is a federal emergency management agency. So they kind of control, supporting the local government when there was like a disaster, hurricane, flooding, and all that. They are the one that that's helping out, right? And so they're also managing the flood insurance programs, and also enforce requirements as well. So here are a couple of key provision and objective for national flood insurance. Hold up. Let me see. Hold on. I'm sorry. Okay. Do you see my slide? Did you see my my second slide? Or
no.
No.
Still the first one. Yeah.
Okay. So my son just said that I only see the first slide. What's going on? Okay. Let me reshare. Maybe I only share my my desktop. Sometime when I do the full screen, I lost the slide deck. So do you see number 13, National Flood Insurance Act, NFIP?
Yeah, we got it.
Okay, cool, awesome. Okay, so like I say, FEMA is the it's an agency, a government agency that help and support and facilitate rescue missions, providing aids into the flooding area throughout the U.S. right, and they also provide like insurance program, enforcing requirements and all that stuff. Okay. So the key provision and objective of the NFIP include flood insurance coverage. The act requires property owner in designated special flood hazard area which stands for SFHA, okay, Special Flood Hazard Area, to purchase a flood insurance if they have federally backed mortgages or loan from federally regulated or insured lenders. What does that mean? Okay, so FEMA require that property owner to buy flood insurance if their mortgage, if the loan that they take out, either FHA or VA, okay, which is it right here, right? You get the mortgage loan from federal, regulated programs, right? So if you have those programs, you need to have a flood insurance. But what happened if conventional, right? What happened if non-QM? You don't have to, but you rather buy it. Oh, but the thing is that sometimes the lender require you to, right? If you're in those area and you have a conventional or non-QM, I hope by now everybody know what is mean by conventional and what does it mean by non-QM. Conventional is are loan programs that meet the guideline of Fannie Mae and Freddie Mac guidelines. Okay, those programs meet the guidelines of Freddie Mae and Freddie Mac. Non-QM is a lot of time when we talk about conventional, that mean it's a qualified mortgage. The one that doesn't meet the guidelines are called non-QM, which is non-qualified mortgage. That is that easy, okay? So, the lenders, right? If the property is in the flooded area, lender also require to buy the flood insurance. Otherwise, they're not gonna lend you the money. Okay, so there's some special requirement from the lender as well. So the NFIP also have a provision for floodplain management, okay, which encourage local community to adopt and enforce floodplain management regulation and zoning code to mitigate flood risk. Communities that participate in the program must meet certain requirements to reduce the potential for flood damage. So meaning that zoning code, okay, meaning that the local government or the county or the city that that in the area that has flood, then maybe they need to have some building code that say this is too low of the area, you cannot build house here. Or if you build house in this area, maybe you need to raise your foundation or maybe on the post for a couple feet, right? To avoid if there's flood coming in, right? It doesn't destroy your house, right? Those are the code that require the NFIP require from the local government or or regulation that's supporting the zoning codes, right? Flood hazard mapping. FEMA is responsible for creating the firms or flood insurance rate maps. Okay, so when you're looking at this firms, right, flood insurance rate maps, so meaning that the map may cover different area of flooding, and depending on the flood, I would say the flood probability, right, that could be happen. So maybe the rate is different between those area on the maps. Firms that identify flood-prone areas and to stop it, flood risk zones, circling stuff. These maps help determine insurance rates and inform land use planning decision. Okay, number 4, insurance rate setting. The Act established the guidelines for setting flood insurance premiums based on the risk of flooding. Okay, if there's the risk number 5, I don't know what the scale is, but let's say if there's a risk number 5 for area A, right? The rate may be $1,200, maybe it's not that much. Maybe let's say $300. Okay, but area B maybe have a higher risk of flood, right? It could be $400, $450, right? So the insurance rate setting is is determined by the Act, and premium vary depending on the property location and elevation relative to the base flood elevation. So there may be an index, right? A number, which is called BFE or base flood elevation, right? Depending on how high that is compared to the the sea level. Let's put it that way. And if the higher the number, right, then maybe the rate is lower, right? Because you're at a higher land, then the chance of getting flood is low. So the flood rate may be lower. Okay, financial solvency. The NFIP aims to be financially self-sustaining and not reliant on taxpayer funds. Insurance premium paid by the policyholders fund the program operation, claim payment, and floodplain management efforts. Okay, so you can see, right, if there is any flood that needs aid, then I think this NFIP will have a program that's gonna, get the money from, from the insurance and then pay for it. Okay. So meaning that, if the house that you buy in the flood area and there's a major hurricane and flooding, and then it's probably gonna damage the house, then you can claim and then get the money from NFIP to help fixing the property. Disaster assistance reduction by providing access to affordable flood insurance. Okay, so because there are areas that may have flood, right? And people may not have enough money to buy the insurance, right? So the NFIP want to make sure the flood rate and all the insurance meet the affordable criteria, so that everybody can buy insurance in the flood-prone areas. Okay. Floodplain development regulation. Participating in communities are required to adopt and enforce regulation to restrict or control floodplain development to minimize flood risk and protect both property owners and the environment. So they, just local community, including local government departments, whatever, come together, come up with plan that can reduce the flood risk. Okay, maybe building sandbags or something, wall. Okay, deeper river, water stream, so that flood can redirect to a different area and not affecting the residential area. Okay, floodplain mapping update. FEMA periodically update flood hazard maps to reflect changes in land use development and flood risk factors. So meaning that over the time, there are probably a lot of development in the area or in the area of the flood, and FEMA are gonna keep monitoring the area and update the flood map accordingly. See if any change in the on the land surrounding those areas, take into account of flood hazard. Okay. Flood risk communication. Property owners are provided with information about their flood risk, the benefits of flood insurance, and steps they can take to reduce the flood damage through community outreach and education. So they provide like different kind of, education classes and teaching, property owners or community about the flood and how to handle, how to, buy insurance and how to mitigate, losing property, if the flood. Okay. So the National Flood Insurance Program provides insurance to owners of improved real estate or mobile homes located in special flood areas. Okay, special flood hazard areas stand for SFHA, right? To help reduce the social economic impact of floods. Okay, the SAFE Act requires, right? We talked about the SAFE Act, right? SAFE Act was RESPA. Yeah, I think it's RESPA that was introduced throughout 2008 issues. So the SAFE Act requires the following licenses before engaging. Let me see. Okay, through the same online registration. Let me see. What do I say? Have this line here? I'm sorry. I think like this slide just carry on from the previous slide deck, so we can ignore this. It shouldn't be in here. Okay. Anyway, sorry about that. We're just going to carry on to the National Flood Insurance Act, which is established in 1968, launches NFIP with two primary goals. First is to reduce the future flood damage and also protect property owners. Okay, protect property owner by providing insurance so that if there's flood damages, property owner can claim and then rebuild the home. Flood insurance is required for property in the flood zone. So we talk about this and manage it or identify the flood zone or identified by the FEMA. NFIP is managed by the FEMA and is delivered to the public by a network of more than 50 insurance companies and the NFIP direct. Okay, so FEMA is like appointed like at least minimum or at least 50 insurance company to sell insurance to property owners in the flood zone. Okay, FEMA is responsible for creating 100-year floodplain maps. Okay, so they probably have data dated back a couple hundred years, right? And they can predict with the modern day technology and all that, they can say, okay, there is a chance that 2025 may have like 100-year flood. Okay, so they can map it out and see which area may get affected if there's like a major flood, right? So they can come up with like a special map, right, to map it out, any area that may affected by 100-year flood, which is, I assume, it's a big flood. Okay. Okay. The next one is a Flood Disaster Protection Act, established in 1973. Oh, what happened? Let me see here. I think I have this slide and that slide kind of reversed. Okay, so actually this is right. I think it just went a little bit fast. That's all. Okay, number 14, Flood Disaster Protection Act. What is it? It's a U.S. federal law enacted in 1973 to address issues related to flood insurance, floodplain management, and protection of property located in the flood zone. Okay, so the previous act, which is the NFIP, right, established to say, hey, everybody needs to have insurance, and they have several provision that require flood, right, in those areas. And this act is actually focused on the FDPA, is focusing on the insurance, the management of the floodplain, and also protection of property located in the flood-prone areas. The FDA complements and works in conjunction with the National Flood Insurance Act, right? FDPA work with NFIA and the National Flood Insurance Program to reduce the financial impact of flood disaster on property owners, community, and the federal government. So it's mandated the flood insurance, right? The FDPA required that property located in the special flood hazard area in the SFHA to be covered by flood insurance if they have federally regulated insurance mortgages. Okay, so meaning that the FDPA say if a homeowner bought this home, which is in the flood area, identified by FEMA, and the loan that they take out is the FHA or VA, they should be able to get a flood insurance. Okay, and lenders are responsible for ensuring that the borrower maintains flood insurance coverage. Okay, so lender say, hey, you take an FHA, you take in a VA, you need to have flood insurance, and you need to maintain it. You cannot drop it. Okay, if you drop it, meaning that, hey, I have money, for first year I buy flood insurance, but subsequent year I'm out of job and blah 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 blah. I don't have money to buy flood insurance, so I don't buy it. Then the lender need to monitor that and make sure every year they got an updated flood insurance declaration from the insurance company, and then they keep track of that, right? And also if the owner drops the insurance coverage from the insurance company, maybe the insurance company need to report that to the lender too. Okay, so if the lender found out that you don't have a flood insurance and you have FHA or VA loans, and then they may force you to buy it, and if you don't buy it for a certain period of time, they may execute a clause. Oh man, I forgot what that clause is. Let me see. Oh man, I just forgot the name of the clause. I just lost my thought on that because I don't have that on the material. But that clause say, okay, you don't have the flood, I will want to ask you to pay back all the money that you still owe. Okay. And if you don't have the money to pay back, either you sell your house or we're gonna foreclosure your house. Okay, because we demand you to pay back. Okay, because you're violating an agreement in the mortgage that you take out. Okay. Okay, and let me see. Mandatory floodplain management. The FDPA encourage community to implement and enforce floodplain management. Okay, and must adopt and enforce these regulations to remain eligible for federal disaster assistance. So the FDPA say, hey, local government, local community, you need to have a plan for flood management. If you don't, then if something happening, if there is a major hurricane going to damage your community, then you are not qualified for federal aid or assistance, right? They blame on you because you don't implement any any plan for flood mitigation, right? And when that happens, they won't send aid. They say that, but when thing happen, local government will find a way to do to provide aid. So don't worry about that. But at least they say that you're not compliant, right? And we're not gonna send any assistance to you. Okay, insurance compliance. The FDPA provide mechanism for ensuring compliance with flood insurance requirement. Lenders are responsible for monitoring and ensuring borrowers maintain flood insurance, and penalty back can impose a non-compliant. Okay, like I say, insurance compliance is that insurance company as well as the lender need to monitor and work together, to make sure the homeowner has a flood insurance. Flood insurance premium. FDPA established guideline and for setting flood insurance premiums based on the property risk of flooding. This is kind of repeated again, right? FDPA is similar to the NFIP, right? They want to have some kind of premium, based on the elevation of the PFE, right? The risk, non-risk, low risk, high risk will have a different insurance rate or premium. Okay, floodplain mapping. Also the FPA mandate that FEMA gonna have, creating and updates the flood insurance rate map. Okay, grandfathering provisions. The FDPA includes provision to allow property owners to maintain their existing flood insurance rates, even if their properties are remapped into higher risk zone. This is grandfathering. Helps to mitigate the potential rate increase due to map revision. Okay, so let's say that 1980, your grandparent bought a home, right? And at that time, they have a rate for that particular area, let's say $200, right? And over the years, they keep updating the floodplain maps, the firms, right? And then when that changed, right? Because like you bought back then, this is how much you pay for the flood insurance. But now things change, the map get updated, the rate table get updated, and everything, right? You still pay the same old, premium that you pay in the past. Okay, so this FDPA enforce that. Okay, so let's say your grandparent probably doesn't have enough money to pay for higher and increasing flood rate, right? So the FDPA ensure that hey, if you bought this a long time ago, you pay the same premium. All right, lender requirements. Lenders are required to notify borrowers of their flood insurance requirement. Okay, so just disclosure, right? Lender is required to disclose that you in the flood area, you need to buy flood insurance. Okay, that's a mandated. Annual premium. The FDPA allow FEMA to increase flood insurance premium each year to reflect inflation and actual rate changes. Okay, so FEMA have the power to increase the rate, okay, due to inflation, right? Like insurance too, right? So that also saying, regarding to the grandfathering provision, right? Even though that they don't pay the rate as high as they pay in the past, but there is a chance that a certain percentage will increase, right? When we're talking about percentage, then the amount probably less if you pay, lower number in the past, right? Let's say, okay, FEMA say, the inflation is high now. We're going to increase 5%. Okay, if you pay 500, if you pay 200, now it's increased 5% on 200. Okay, now if the premium rate is 350, they increase 5% on 350. Now, whoever got a 350 rate will pay just a little bit higher. Okay, disclosure agreement. The FDPA say, you gotta have disclosure, right? Even the property seller, right, need to disclose. Okay, the seller need to disclose that, hey, this how I am disclosing to you, the buyer, this house is in the flood area. You want to buy it? Good, buy it. Okay, if you don't want to buy it, walk away. But if you're buying it, probably there's some requirement that you need to buy insurance, flood insurance. So the seller is required to disclose all that information. Okay, Flood Disaster Protection Act. Again, the mandatory flood insurance purchase requirement of the FDPA, and again, significantly amended with the passage of the Bigger Water Flood Insurance Reform Act of 2012. So this act back in 1973 get an update or get an amended, by the HFIAA, actually for the Bigger Waters Act in 2012, and also the 2014 HFIAA, which is Homeowner Flood Insurance Affordability Act. Okay, so there are two additional acts introduced in 2012 and 2014, say that, okay, we make some update, to the FDPA, okay, to include, these two acts. And these statuses make change to the provision pertaining only to forced placement of flood insurance. Okay, meaning that you need to buy. It's a mandate. You need to buy flood insurance. You cannot say that you don't want to buy it. Okay, so it's a mandate. Escrowing of flood insurance premium and fees. Okay, so we're talking about the escrow account. Okay, the escrow account is where you put your property tax money in it. You put your fire insurance payment in it. Excuse me, and you put your mortgage payment in it. Now, if you're in the flood area, now you have to add the flood insurance payment in the escrow account as well. So that's a requirement. Okay, from these two new introduced laws. Exemption to the mandatory flood insurance purchase agreement. There's some exemption to the flood insurance purchase requirement. We're gonna talk about it later. And if you don't buy flood insurance in the flood insurance prone or the HSAS or something, I forgot the name. Let me go back. I'm sorry. Where is it? SFHA, Special Flood Hazard Area. Okay, then if you don't buy it, you're gonna get civil money penalty. You're gonna get a pay fine if you don't buy it. So these two laws enforce these new changes. So structures eligible for flood insurance under the NFIP, or let's say the property eligible to buy flood insurance under the NFIP, including residential, industrial, commercial, and agricultural buildings. Buildings under construction where a development loan is made. Okay, meaning that let's say if a company building a building, right, and they borrow a development loan, they need to buy flood insurance. Okay, because like while you're building the building, then flood comes, it destroy your building, right, or damage your building. You have to have insurance cover for repairs. Okay, so it's required that. Mobile homes that are affixed to a permanent site. Okay, so we never talk about mobile homes. If you haven't known or aware what mobile homes are, meaning that mobile homes sometimes is on a tractor. Mobile home sometimes is on movable foundation, but also there are mobile homes that on a fixed foundation. So meaning that they build like a slab, a foundation, then they put a mobile home on top of it. Okay, but you can bring a cane and then hook it up, bring the home somewhere else. Okay, that's fine. But mobile home on a fixed permanent site need to buy flood insurance. Condominium need to buy flood insurance. Cooperated buildings. What is cooperated buildings? Condominium is just like apartments, right? You have an apartment, 2 or 3 stories, and there may be several units per floor. Those are called condominium. But what is cooperated buildings? Meaning cooperated buildings, you need to buy flood insurance too. Okay, but cooperated buildings meaning there is a high rise, maybe 10-story high, 20-story high. Everybody in that building own a unit, right? Own a unit meaning own a percentage of the asset of the whole building. Okay, so that's what is called cooperated buildings. So mainly a lot of cooperated buildings are units within a high rise. Okay. Okay, structure not eligible for flood insurance under the NFIP. So these are the exception. It's not eligible for flood insurance, meaning that you cannot even buy flood insurance. Okay, it's not saying that you don't buy, but you cannot buy, which include unimproved land, bridges, dams, and roads. Actually, and roads and detachable mobile homes. Okay, with detachable mobile home, you can haul it to somewhere else. You put it on a tractor, or you haul it somewhere else. Okay, trailers and campers converted into buses or van. Converted buses or van. Okay, so that understandable and easy to understand, right? Building entirely in, on, or over water into which boats are afloat. Okay, so maybe there's a boathouse, or maybe there is a boat on the dock, situated on a lake. Then those are not eligible to buy flood because you right on the water, right? You can be sinking. You can if the big wave coming in is gonna knock you down and sink. Okay, next thing. Homeowner Flood Insurance Affordability Act. So we just covered that two new act here, right, under FDPA. And now we're going to talk about Homeowner Flood Insurance Affordability Act, which is introduced in 2014. So what is it? It's a federal U.S. law enacted in 2014, introduced to respond to concern about significant increases in flood insurance premium under the Bigger Water Flood Insurance Reform Act. Okay, so the Flood Insurance Reform Act, which is, if we go back to here, which is the one that amended in 2012, require that everybody to pay flood insurance, which actually drive up the premium, right? And it's out of reach of many people. So the 2014, came out with the Homeowner Flood Insurance Affordability Act to actually, mitigate that rate hike, right? And then to create the affordability measure, right? The HFIAA established, measure to limit the rate increase for certain policyholders under the National Flood Insurance Program. It slowed down and mitigated some of the premium increases that were mandated by BW12, which is the Bigger Water Act 2012. Okay, if you see BW-12, then that is the Bigger Water Flood Act, Reform Act of 2012. Okay, so it just the HFIAA. You maybe come up with a way that you can pronounce it. Okay, HIFA or something like that, or FIA. Okay, so this actually helped to lower the premium so that the homeowner that doesn't qualify can buy flood insurance. Grandfathering provision, right? The law retained and expanded the grandfathering provision that allow property owner to maintain their existing flood insurance rate even if their property are remapped. Okay, we will talk about this. Okay, even grandfather in, but if FEMA increased the rate due to inflation, then this grandfather in also have the effect too. I don't think they can just keep the same payment. The rate may change, but they cannot. The rate change causing the payment to increase just slightly, because when they change, they want to increase the rate, it's gonna affect it across the board, right? Regarding when you bought the insurance, or regardless of the high risk low risk area. Okay, annual rate increases. HFIAA placed cap on annual flood insurance rate, increased individual policy, preventing extreme premium hike. The law limit the rate increase to 18% per year. Okay, so they put a cap on the hike of the rate. Okay, because they don't want the rate to go too high, so they cap it at 18% per year. Pre-firm subsidized rate. This law reinstated the ability to property owners to assume the pre-flood insurance rate map subsidized rate when purchasing property that were built before the community entered into the NFIP or when the property is sold to a new owner. So meaning if the property is in an area, right, before they change the map and they purchase for that particular rate, and then even with the new owner coming in and buy it, buy the property, we're probably going to inherit that rate as well, and that rate is the rate before the map got updated. Okay, refunds and credits. The law authorized refunds and credit for policyholder who had been charged higher rates under BW12, but were subsequently eligible for lower rates under HFIAA. Okay, so if there's any discrepancy in the rate, then they can get a refund and a credit for whatever the amount of time that they overpay. Flood risk education. This law requires FEMA to develop and implement an outreach and education program to help property owner understand their flood risk and insurance option. So usually when in this kind of area, right, when you buy a house, you in escrow, and they're gonna run a natural hazard disclosure, right, by a third party. Then that third party gonna identify this home is in a fire risk area, in an earthquake area, or in a flood area. So they're gonna disclose all that. So FEMA, gonna probably get involved even more by providing some booklet. Okay, that this booklet is for the flood zone. Okay, and you, the owner buying a property, read this. Okay, so the law just try to cover all the aspect of it. You read it or not, it's your issue. Okay, not the law, not the the program or even the transaction. Okay, flood risk education. Okay, flood mapping and affordability. The law mandated an affordability study to examine the impact of the flood insurance rate changes on low and moderate income policyholders and suggest potential option for addressing affordability concerns. Because over the time, the rate gonna keep hiking. Because imagine this, if they're like a hurricane every single year, like the insurance company not gonna be able to sustain. So they have to keep increasing the rate, right? So the government, local government, state government, federal government, they have to come up with ways to help pay some of that hike. Because like if they don't pay hike, this insurance company gonna bankruptcy and they're not gonna be in business, right? So federal government, state government, local government have to come up with programs to help with the payment. Okay, so that's what it is. Reauthorization. HFIAA reauthorized the National Flood Insurance Program until September 30, 2017, ensuring the continued availability of federally backed flood insurance coverage. Okay. So reauthorize. Yeah, a little bit confusing on this one too. They just say that the flood insurance should be available for up to September 30th, 2017 for any people that need to buy flood insurance. Okay, a little bit more. Okay, the HFIA repealed certain parts of the previous law, bigger waters, restoring grandfathering, putting limit on certain rate increase, and updating the approach to ensuring the fiscal soundness and fund by applying an annual surcharge to all policyholders. This is a little bit woody and hard to understand, but it's a summary of the HFIAA. You probably are aware that in this slide deck I actually take out the why. Okay, because these are really straightforward. Okay, and these are more or less smaller act compared to the one that we saw from previous classes, right? So I don't put a why in here. Okay, I only see what and some some details about the act. Okay, regulated and enforced by FEMA, direct FEMA to make available rate table that implement this repeal. Consult with the right-your-own companies when developing guidance on rate table to implement this act, meaning that insurance company have to come up with their own rate table and then provide it to FEMA. Refund to insure directly flood any insurance premium under an FIP that exceed the rate required under this act. Okay, if there's any so I assume 2014 when they realized that the BW12 overcharged, right? So when they introduced this act for 2014, they probably asked the insurance company to do some adjustment, right, to due to the BW12. Okay. Permit the purchaser of any property covered under an existing flood insurance policy upon its purchase date to assume that the policy at the chargeable premium rates for the remainder of its term. Okay, so let's say if somebody pay for the rate for the full year, and if you buy the a new owner coming in buy the property mid-year, then the rate gonna carry all the way to the end of the year, and then that rate may change after next year or after this year. Okay, requires federal lending regulators to direct each regulated lending institution or servicer of an outstanding loan to offer and make available to borrower the option to have flood insurance premium and fees, including any escrow of them. Okay, so make sure that all these financial institutions, the servicer that offer some kind of flood insurance or affiliate with any company that's selling flood insurance, so that the the borrower can purchase the coverage. Okay, another one, Flood Insurance Reform Act, FIRA. What is FIRA? FIRA refers to multiple pieces of legislation passed in the U.S. over the years to reform and modify national flood insurance program. These acts have aimed to improve the financial stability of the NFIP, addresses issues related to flood insurance affordability, and enhance flood risk management. So you probably saw that 2012 they did the change, 2014 they did the change, but this was introduced in 2004. Some changes was done in 1994 and 2004, and these are the acts that changed it in that time, and it's also including the BW12 and HFIAA. So let's take a look at the first one in 1994. The National Flood Insurance Reform Act in 1994 introduced changes to the NFIP, including the risk-based premium for certain property and the requirement for community to adopt the new floodplain management regulation. So before 1994, maybe there's no floodplain management regulation. So this act say, okay, now there's got to be a floodplain management, which also including in the NFIP, and BW12 and HFIA as well. Okay, I don't want to repeat those two laws. Also, the National Flood Insurance Program Reauthorization Act of 2018. We just talked about that. Okay, Reauthorization Act. This act authorized the NFIP for any extended period, ensuring the continued availability of federal-backed flood insurance coverage. It also includes provision aimed at improving flood mapping, reducing the repetitive loss properties, and enhancing mitigation efforts. So they just ensure that there's the availability to buy the insurance coverage is continued. Okay, and also some provision to improve the flood mapping, and also try to reduce find way to reduce the continuous repetitive loss of property. Maybe outreach program, better and the mapping updates and stuff like that. Okay, and local communities need to find ways to enhance the risk for flood. Okay, number 5, the Flood Insurance Market Parity and Modernization Act, which is passed in 2019, and encourage the development of a private flood insurance market alongside with the NFIP. So the NFIP is the National Flood Insurance Program. Now, this act in 2019, the act called the Flood Insurance Market Parity and Modernization Act, saying, hey, any private company can do business, offer insurance coverage for flood. Okay, so it's open up competitive. When there's open up competitive, meaning the premium will drop. Okay, and it's going to help the homeowners. Furthermore, right, 2021, the further extension of the Continuing Appropriation Act. This legislation extended the authorization of the NFIP through September 30, 2021. So they was ended at 2018. And now they say, okay, now we're going to extend that to 2021. Say, you have to pay more. If you don't have, you should get the coverage for your property. Okay, so it seems like there's a certain period that certain act going to end, right? Demanding people to buy flood insurance or get the coverage availability, and then that when that act expires, they introduce a new act and they extend that that provision. Okay, Flood Insurance Reform Act. Okay, we talked about that. Repeal a certain part of the previous law. This is just a summary. So the National Flood Insurance Reform Act, we talked about that. The Flood Insurance Reform Act in 2004. Okay, let's talk about this one because I don't think it's mentioned earlier. The Flood Insurance Reform Act of 2004. Okay, so they are the same name. One is amended in 1994, and one is amended in 2004. The 2004 one say further strengthening the NFIP with a number of reforms that include reducing loss of property for which repetitive flood insurance claim payments have been made, right? Because when there is the flood damage, right, homeowners keep claiming it. Okay, creating policyholder awareness about individual flood insurance policy, increasing policy information on guidance about flood insurance claim process, and establish the minimum flood insurance training and education. Okay, so because if you keep repetitively claim flood insurance, then there got to be some training about it, meaning that keep in mind, flood is not only happening by the natural flood, disaster, hurricane, but flood also means that you may have a burst pipe in your home. Okay, you may have some water damage in your home, right? You may have done something in your home and it's causing flood. Okay, or you may let the water run in your bathtub and you go on a vacation, causing a flood. Okay, flood is not only disaster, but flood is within the property itself. So there are programs, there are training that they're provided, so makes you aware that you cannot just keep claiming for insurance. Maybe when there's a disaster, insurance company may not pay. NFIP may pay it. Federal government may provide some assistance, right? But if man-made or repetitive claim that happen so often, then probably you're not even get a claim. 17. Okay, Home Mortgage Disclosure Act. Okay, so now we done with the flood. Okay, So now it's about the mortgage disclosure. When you get a mortgage, you have to disclose. Okay. But what is Home Mortgage Disclosure Act? What is HMDA? It's a U.S. federal law and act in 1975 that requires certain financial institutions to collect report data related to mortgage lending activity. The primary goal of this law is to promote transparency, prevent discrimination, and provide public access to information about the mortgage lending practices by collecting reporting data on home loan. Blah, 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 too much. Okay, pretty much. This HMDA, Home Mortgage Disclosure Act, is already included in the RESPA, which is the newer version of it, right? SIP Act, right? 2010, 2012, right? This is an old act, right? But it's saying, when you lending, you need to disclose all the aspect of it. Okay, the reform, the amended, act later on, in the recent years already cover majority of this act. Okay, data collection. HMDA report cover financial institution, including bank, credit union, mortgage lender, to collect specific data about mortgage application, origination, and purchases. This data including information about the loan type. Okay, so pretty much, right, whatever you do with the lending, the information, the data, the disclosure, all of that need to be retained, need to be transparent and stuff like that. Reporting, right? If you find anything discrepancy, you need to report it to the Consumer Financial Protection Bureau. Okay, also, it's mentioned about the anti-discrimination, okay, similar to the RESPA. Okay, Community Reinvestment Act, which is the CRA. HMDA data is used to assess financial institution complying with the Community Reinvestment Act, which encourage banks to meet the credit needs of the community in which they operate in, including low and moderate income area. Okay, so this act back in 1975, HMDA say that, hey, we're gonna study your data and make sure you're compliant, and you need to lend in the low income, moderate income area. You cannot redlining. Okay, we talked about that, right? Redlining, you cannot pick and choose the community. Fair lending enforcement, number 5. Regulators use HMDA data to identify potential fair lending violation and discrimination lending practices. Okay, this law in the past, they use some data of the HMDA to understand how the lenders, financial institution, lending, right? So that they can come out with new laws to prevent and provide, fairness. Public access. Data is made publicly available to promote transparency and allow consumer researcher, advocacy groups, and policymakers to analyze mortgage. So pretty much, have the data available so anybody can use the data to, study, make new laws. Regulatory oversight. HMDA monitor and assess the mortgage lending activity of covered institutions. Right, they conduct examination to ensure compliance with the fair lending and reporting requirements. Okay, so a lot of this is similar to the SAFE Act. Okay, I will skip the summary up here, but what loans are covered under HMDA? A financial institution must collect, record, and report data for drawing secure business purpose loans and lines of credit that are home improvement loans, home purchasing loan, refinance if no other exclusion applies. So any loan, okay, any loan that including for dwelling, for like primary home, residential property, business loan, okay, credit line, okay, like home equity line of credit, or even the home improvement to use for get the credit line to improve home too. Purchasing loan, refinance loan, right, are covered under HMDA. Okay, so HMDA also try to prevent discrimination, okay, and provide unfairness by implement to identify redlining, blockbustering, reverse redlining, and steering. So what are these? So we talk about redlining, right? Redlining is an act, a discriminatory by the lender, big financial institution, to pick and choose the area or race to serve lending. Blockbustering, a business practice in which real estate agents and building developers convince white residents in a particular area to sell their property at a below market price. Okay, for example, right, realtor or even the builder. I'm saying you need to sell. They knock on the door and say you need to sell your property, okay, right now, because I know that Asian gonna come into this area. Okay, so that's blockbustering. Okay, this this actually creates a fear, right? And say, hey, you need to sell because color people are gonna move into your community, move somewhere else, and sell your home. Okay, so that's called blockbustering. Reverse redlining, right? We talk about pick and choose the community to serve, to not serve. Okay, not land. But now reverse redlining is pick the community that just only lend to that community because they are a trouble community, right? We can foreclose them easily. Steering is the illegal practice of directing prospective home buyer to or away from a neighborhood based on the presence or absence of protected classes. Okay, don't buy in this area. Go buy La Jolla. Okay, because this area have a lot of ghetto. You probably heard a lot of that term, right? If you're a realtor, if you're an MLO, don't ever talk like that because it's gonna get you in trouble, right? You're steering buyer to buy somewhere else instead of buying this area. If the buyer say, hey, I don't like this area, can you show me other area that's better than this area? Then maybe you just follow direction. Okay, you just don't say, oh, don't buy this area, it's a ghetto area, right? There's a lot of crime, there's a lot of issue with this area. You don't know about that, right? If you want to show, then show this area report, right? Crime report, and let the buyer decide if they want to buy this area or not. Okay. Telemarketing and Consumer Fraud and Abuse Preventing Act. Okay, is a U.S. federal law established in 1994 address the deceptive, abusive telemarketing practices. Okay, the primary objective of this law to protect consumers from fraudulent and unfair telemarketing activity and establish rules and regulations governing telemarketing operation. Telemarketing and Consumer Fraud and Abuse Prevention Act is often associated with the Telemarketing Sales Rule, TSR, which is enforced by the FTC, stand for Federal Trade Commission. Okay, enforced to implement the law provision. What are the provisions? The provision is prohibition of deceptive practices, which include deceptive and fraudulent telemarketing practices, including false, misleading representation about goods, services. So pretty much, it's prohibited deceptive practice in advertising or telemarketing or call. Sometimes phone call. Hey, get this loan. Okay, this is a good loan for you. Okay, but it's happened. It's probably not a good loan. Okay, your marketing, your advertising is misleading. Okay, and make the owner, the borrower, get the loan that's not supposed to. Okay, call restriction. Do not call us. Don't call people before 8 a.m. or not after 9 p.m. The government already established a do not call us, a website. Okay, do not call. Okay, you can log on to that website and you don't want any telemarketer to call you. A lot of this thing happened during the, I believe, between 2000 and 2010. There's a lot of telemarketer. Your phone keep ringing every day. Okay, so this law, when it's come out, if you put your phone number right now, even right now, you put your phone number in the do not call us, nobody gonna call you. No telemarketer is gonna call you, right, at all, right? If you don't put your phone on the list, telemarketer not supposed to call you before 8 a.m. or 9 p.m. Okay, until you put your phone on that list. Okay, or if you give your phone number to whoever that you want them to call, right? There's certain thing, certain time frame that that permission, that authorization will expire, right? But if you do not put your phone number on the do not call list, then they don't do. Guess what? let's say you're going to be an MLO. You take on a borrower application. You run their credit. Guess what? The credit agency now have the lead generation that gonna go wide out to everybody, to all lenders, to all financial institution. And guess what? Your buyer gonna keep getting phone call, right? So to prevent that, right, before you run the credit report, tell your buyer to put his or her phone number on the do not call list website. And also, there's another one that let me see. Let me try it. There's another one I forgot. Opt-out screen or something like that. Okay, so you need to put into, because like for the do not call list, it's probably gonna take about 30 days. So for all these marketers to get that phone on their list for not calling. Okay, but when you put that call in, and before you run the credit report, right now, if you have a client, tell your client to go and put your phone on the do not call list, and also put your phone number on the opt-out screen. Okay, those are the two websites that you put it on. Then within 3 days, right, it will appear on all of the telemarketers. Okay, so they won't call you at all. Otherwise, if you run the credit report, then your client gonna start receiving phone call. Then your client gonna ask you, "What's going on? Did you give my phone number to all these telemarketers?" Say, "No, I don't." But because the credit agency have affiliate with institution, and then when that happened, that lead generation come out to all the lenders, right? All these institutions, and that's why they got the phone number and they call. Okay, so telemarketing app also require disclosure. Telemarketers are required to disclose specific information during their call. They call you, they need to say, who are you, why they call, okay? Even with like charitable organization, the purpose of the call, why you call me, right? And any material information that could influence a consumer decision. If you try to sell something, you want the receiver of the call to buy something from you, you need to require some disclosure. It's okay that you can call as long as they're not registered on any do not call list. But when you call, you have to disclose too why you call. Okay, telemarketers sell rule at TSR. It's a set of rules and regulations that implement the Telemarketing and Consumer Fraud and Abuse Protection Act. It's including provision related to deceptive practices, call restriction, required disclosure, and among other consumer protection. So this rule, TSR rule, right, have some provision in it, right? No deceptive practice, right? No, don't call if they're on the restriction list, okay? And also some disclosure. Advance fee ban. The Act and TSR prohibit telemarketer from requesting and or accepting advance fee for certain type of product or services such as credit repair, debt relief, and recovery services until specific results are achieved. So let's say if there's a company that fixing the credit score, right? They cannot get the fee of fund until some result already proven. Okay, so they're not supposed to get any money at all until they actually show some results. Cooling off period. The law provides consumer with a 3-day cooling off period during which they can cancel certain telemarketing contract without penalty. Okay, recording, keeping, and complying. Telemarketers are required to maintain records of their telemarketing transactions and operation and comply with the FTC requirements related to record keeping, reporting, and other regulatory obligations. So they can do business in telemarketing, but they have to keep a proper document, right? Who you call, when you call, how long you call, why you call this person, right? Because they're not on the list. Enforcement, FTC will enforce this, will penalize any telemarketer, violate the law. Okay. I'm a little bit run over. Give me 5-10 more minutes. Okay. I have one more act. The act is meant in control over telemarketing and give more control to prescribe rules. The Federal Trade Commission, after passage of the act, the Federal Trade Commission is required to first define and prohibit deceptive telemarketing practices, keep telemarketers from practice a reasonable consumer would see as being coercive or invasion of privacy. Set certain restriction on the time and day and night, and stop the unsolicited call, right? To require the nature of the call to be disclosed. Okay, we talked about that. Okay, I think I think I mentioned a lot of this, like do not call before 8 and 9, after 9, prohibit call to consumer who have asked not to be called again. Right? I already told you, you call me, I told you again, don't call me again. If you call me again, you're violating this act, this law. However, the MLO like us might solicit a call to a client, but on the do not call list, even though they put their number on the do not call list, but as an MLO, we can call them with some restriction. If that person that you call is your client up to the last 18 months, then yes, you can call them. But if past the last 18 months, you cannot call them unless they provide you a permission or they give the number again, or they say, okay, I need a new loan. They become your new client, and then you can call them again up to 18 months after that, after the close of the transaction. A prospective client who submit an inquiry up to 3 months, right? Somebody go into your website, enter phone number, say, I need a loan. You can call them 3 months. And if they're not your client no more, don't call them. Okay? A client who has given written permission may solicit with an unspecified time, even if on the do not call list. A client agree with a written permission. Say, okay, I allow Mr. Manho and MLO to call me whatever. Okay, no restriction. Then you can call them forever. You can call them at night and to check, but not before 8 or after 9. Okay, telemarketer who violating the law will be fined up to 40,000 per call. Okay, be careful on that one. 40,000 per call. So this bring up, you're probably not going to call people that much, right? Unless you follow the guideline on the right side here, right? But sometimes we're using a virtual assistant, right? We're using virtual assistant. The virtual assistant gonna go out, find the lead, make some phone call, right? You pay the virtual assistant a fee, right? A service fee, so they do the job for you. But be careful when you're using them. Make sure they follow this guideline. You may have to study their business first, right? Make sure they follow this guideline. Otherwise, because they call the client on your behalf, you are the one that's gonna get in trouble. So be careful when you're using the virtual assistant. Okay, last one. Homeowner Protection Act, HIPAA or HPA, introduced in 1998. It's a U.S. federal law enacted in 1998, officially known as Private Mortgage Insurance, the PMI. Or should it say PMI Cancellation Act. The primary purpose of the Homeowner Protection Act is to provide certain rights and protection to homeowners who have private mortgage insurance coverage on their home loans. PMI is typically required when a home buyer makes a down payment of less than 20% of the home purchase price, and it serves as an insurance for the lender in case the borrower defaults on the loan. I hope that's clear as the sky. However, let me explain it a little bit. When somebody go out and buy a property, borrow a loan, but doesn't have enough down payment, doesn't have up to 20% down payment, right? So when that person doesn't have up to 20%, let's say that person have only 15%, so 5% difference. So that person gonna have to pay what is called a PMI. And a PMI is a private mortgage insurance, okay? And the amount could be varies, okay? If it's only a short period of time, you may maybe pay $79 a month, or sometime up to $250 a month, okay? So you're gonna pay until you're gonna bring the balance, right, up to 20%. Now you only have 15% as your equity, right? And when you keep paying over time, right, each month you pay into the principal, and then eventually your loan going up, then it's meet the 20%. And at that time, the HIPAA allow you to make a call into the servicer, the one that serviced your loan, right, or the lender, and say, hey, I meet my 20%. Okay. Please stop the PMI payment. So now your mortgage payment going to reduce, let's say $79, because you don't have to pay for that PMI anymore. Okay. And so that's what it means. Okay. So you can, but you have to call in if you reach the 20%. However, if you reach the 22%, because you don't pay attention, you don't even know that your the equity is growing. Guess what? What happened if your home appreciated over time, right? Your home, when you buy it, maybe 500,000. 5 years from now, your home go to 600,000, right? And then that difference in equity appreciation gonna help you surpass the PMI requirement, right? So that means that, because you don't even know, right? Maybe within 3 months, 6 months, your appreciated value is growing so fast that it's past 22%, 22% or more, okay? Then the lender, the servicer will automatically stop the PMI. You don't have to make a call, okay? Or maybe you keep paying and you don't pay attention. And then when you pay past 22%, then the servicer will stop the PMI automatically. And you may wonder, oh, why is that this month my payment is dropped $79, right? Because of this law, okay? The final PMI termination. Lender must terminate the PMI once the borrower equity reach 78% or 22%, okay, of the original home value. When we talk about loan to value, okay, loan to value, meaning LTV, okay, meaning that you still owe the bank a certain amount, okay. LTV is loan to value. Yeah. So let's say if you pass 22%, if you at 22%, so your loan to value is 78%. Let's say if you're beginning the purchase of this home is at loan to value of 90%, then you pay over time or the market appreciation, and then your loan to your COM for your home is going up, right? And then your loan to value dropping to 78. It meets the criteria. Then the lender will stop collect the PMI. Okay, disclosure. HPA require lender to disclosure, including the information on when and how PMI can be canceled. Okay, HIPAA is say, okay, you need to disclose this. If you lenders disclose that, okay, if you pass 20%, you can give us a call. We drop that PMI, or when your value grow beyond 22%, we're gonna drop it automatically for you. New loan. HIPAA applies to most residential mortgage loans originated after July 29, 1999, subject to PMI coverage, including loans secured by a single-family home, condominiums, and other eligible properties. Okay, so these are the assets that the PMI is applicable to. Exemption. A HIPAA doesn't apply to certain government-backed loans like FHA and VA loan, okay, which they have their own PMI-related rule and requirement, right? So HIPAA doesn't cover any loan originated, for FHA or VA. Okay, remember that. However, FHA does have a PMI itself. Okay, and we're gonna talk about that, in the future classes. Okay, so we talk about PMI Cancellation Act. The Homeowner Protection Act in 1998 is a law designed to reduce the unnecessary payment of the PMI by homeowner who may no longer require to pay. Okay, we talk about LTV of 80% or 20% on the equity. PMI premium is paid by the borrower. Okay, not the seller, not the lender, by the borrower. When the LTV is 80% or less, you call in to be removed. Lender have to accept it. When it's PMI higher than 22% or loan to value is dropping to 78%, automatically do it for you. Some lender agree to totalize the PMI cost and pay upfront by either the borrower or lender as an incentive. Okay, what does that mean? Okay, we're talking a bit about PMI, right? So meaning that if you get lower than 20%, then you have to pay PMI. But recently, back in 2021, okay, they have, or maybe it's been a while. It's been around for a while. But back in 2021, due to competition, right? Lenders say, okay, let's calculate your PMI. If you pay $79 for 5 years, and that's going to bring you 20% or more, right? How about I accumulate all that into an amount? Let's say $6,000, okay? Because of competition, I'll pay you $6,000. So now you don't have any PMI, okay? Even though that you are less than 20%, right? I'll pay your PMI, okay, upfront, so that particular loan, that particular buyer doesn't have to pay the PMI due to the competition of the mortgage industry. Okay, so keep in mind that can be happen if you have a client and then find out if that that lender that you use for your client willing to pay the PMI. Okay, but like I say, most of the time when there's a big competition, then lender will do that for your borrower. Okay. Sorry, over 16 minutes. Anyway, so that's it. Anybody have any question? Thank you for sticking around. Anything? Too much? Okay, any last question before we stop for the night? If not, we're not gonna have class tomorrow. Okay, we will resume the class next Monday. Okay? Have a good weekend.
Yeah.
Yeah.
Happy Friday Eve.
Bye you.
Yeah.
Okay, bye Trung Hoan.
Yeah, bye. Yeah.